Module 1. Receivables, IFRS and GAAP. Under both the United States developed Generally Accepted Accounting Principles, or GAAP, and the International Financial Reporting Standards, or IFRS, the allowance method is used to estimate uncollectible accounts, and the expense for estimated uncollectible is recorded in the same period as the revenue generated from those receivables. However, when a receivable is determined to be uncollectible, the expense is recognized immediately under GAAP. In contrast, under IFRS, the previously recognized allowance is written off against the receivable, and any additional write-off is recognized as an expense. Accounts receivable turnover. Accounts receivable turnover is a financial ratio that measures a company's effectiveness in collecting its accounts receivable. It is calculated by dividing net credit sales by the average accounts receivable balance during a given period. The formula for accounts receivable turnover is as follows. Accounts receivable turnover equals net credit sales divided by average accounts receivable, where net credit sales equals total sales minus cash sales plus sales returns plus allowances. Average accounts receivable can be calculated by adding beginning accounts receivable plus ending accounts receivable and then divided by 2. A high accounts receivable turnover ratio indicates that a company collects its outstanding debts efficiently. In contrast, a low ratio may indicate that a company is difficulty collecting its outstanding debts. However, it is essential to note that different industries may have different average turnover ratios, so comparing a company's ratio to the industry average or its historical ratios is essential. Expense recognition principles. Under the allowance method, bad debt expenses are recognized in the same period as the related sales are recognized, and a contra-asset account, allowance for doubtful accounts, is used to reduce the reported amount of accounts receivable to their estimated net realizable value. The allowance for doubtful accounts is based on an estimate of uncollectible accounts and is adjusted over time as experience differs from the estimate. Bad debts. The write-off of a customer's account receivable under the allowance method reduces the accounts receivable and the allowance for doubtful accounts by the same amount. There is no effect on the company's total assets. However, there is a decrease in net income as bad debt expense is recognized in the same period as the related sale, and the write-off of the account is an adjustment to the estimate of bad debts made earlier in the period. The reduction in net income is equal to the amount of the account receivable written off, less any allowance previously set up for that account. Interest receivable adjusting entry. When a company has earned interest on a loan or investment but has yet to receive the payment, it records the amount as interest receivable. At the end of the accounting period, the company must make an adjusting entry to reflect the interest earned or accrued during that period. Here is an example of an interest receivable adjusting entry. Suppose a company has invested $50,000 in a bond that pays 4% annual interest, with interest payable on December 31st of each year. The accounting period ends on December 31st, 2022, so the company needs to make an adjusting entry for the interest earned or accrued during that period. The entry would be, interest receivable is $2,000, 50,000 times 4%. Interest revenue is $2,000 when collected. In this entry, the interest receivable account is increased by $2,000 to reflect the interest earned but has yet to be received. The interest revenue account is also increased by $2,000 to recognize the revenue earned during the accounting period. Note that the adjusting entry is necessary to properly match revenue and expenses in the same accounting period per the accrual basis of accounting. Total assets. Total assets represent the sum of all resources owned by a company or an individual which have the potential to generate economic benefits in the future. For a company, total assets include both current assets and non-current assets. Current assets are those expected to be converted into cash within 1 year or one operating cycle, whichever is longer. Examples of current assets include cash, accounts receivable, and inventory. On the other hand, non-current assets are those expected to be held for more than 1 year. Non-current assets include property, plant, equipment, long-term investments, and intangible assets. The total assets of a company are reported on the balance sheet, which is a financial statement that summarizes a company's financial position at a specific time. The balance sheet is divided into assets, liabilities, and equity. The total assets are reported at the top of the assets section and represent the total resources available to the company. Total assets are an essential measure of a company's financial health, indicating its ability to generate future cash flows and meet its financial obligations. However, total assets should be analyzed with other financial measures, such as total liabilities and equity, to gain a more complete picture of a company's financial position. High returns on total assets are desirable.